Thank you again for joining us. Now I'm going to turn it over to Matt Mickelay, Senior Manager of Risk Advisory at Baker Tilly.
All right, thank you. Thank you everybody for joining us this afternoon for a discussion on ESG and its impact on the private equity space. As mentioned, I'm Matt Mickelay. I'm a Senior Manager with Baker Tilly's Risk Advisory practice. I sit in our Minneapolis office. I have been working on different ESG initiatives now for the past year or so, helping our clients develop policies and procedures and help them navigate the different risks and opportunities that ESG is presenting right now. So happy to be with you all this afternoon. I'll turn it over to my colleague, Jim Shoppy, for an introduction as well.
Hi, good afternoon, and thank you, ACG, for allowing us to present this topic. My name is Jim Shoppy. I'm a Senior Manager in Baker Tilly's Risk Advisory practice. I have a wide range of experience, including forensic accounting, financial statement audit, and tax services. I primarily work on internal audit and SOX compliance type projects. However, I am a part of a team along with Matt, working with clients to understand the complexities around environmental, social, and governance, and I'm working with them to assist in implementing policies, procedures, and controls around, ESG reporting. If I go next to the agenda, what we're going to be talking about today is, what is ESG, the current ESG landscape, standards and frameworks, ESG impacts for private equity and responding to ESG. Matt's going to be covering the first three, and then I will be picking it back up with the last two. And before we get into the presentation, we have a little polling question to just, gain a little bit of insight of, who's on the other end and see where you are in your journey. So, whether you're all in and you're already using ESG assessments to determine value, or if you're, just early in the process and considering ESG, or starting out, or nothing at all. And I think as the survey results are coming in, I think it's, generally what I thought, some all in, but it's looking like a majority are in process or starting out.
All right.
So I think with that, it's, nice to know where everybody is with this, and I'll turn it over to Matt to begin his end of the presentation.
All right, yeah, thanks, Jim. Thanks everybody for providing responses there. Looks like we had a few folks who ESG is new to them, but as Jim mentioned, most folks are sort of in process and kind of evaluating what it is and what your entity should be doing for it. So as Jim mentioned, I'll kind of give an overview of really what ESG is and where we're at right now, what the current landscape is, what the marketplace looks like, and what are the different drivers out there for kind of how we've gotten to this spot with ESG and why it's becoming such a hot topic. So essentially, I mean, ESG, the way we'll look at it for purposes of today's discussion is it's a consideration of environmental, social, and governance factors alongside financial factors in the investment decision-making process. So what the pandemic has done really over the last year and a half is it's kind of spotlighted the importance for entities to integrate ESG with their long-term corporate strategy. It can't just be about the financials anymore. Entities and organizations are being forced to look at other factors, the E, S, and G that we'll talk about here, and how those are impacting their business, and how do these risks and opportunities drive the business? How can they provide value beyond just the financial statements? So the consideration of all these factors alongside the financial factors has to be taken into that long-term value creation process. So when we talk about the E side of things, that the environmental, that's just the contribution an organization might be making to things like climate change, waste management, energy efficiency. The social side of things comes into play too as well. I think a lot of people that we talk to and clients we talk to, when they think ESG, they just think the environmental side of things a lot, but there are other aspects too when you think about the social side of things like human rights, supply chain labor standards, product liability, and even workplace health and safety. So looking internally, not just externally, but how are entities addressing those risks with workplace health and safety. And then, of course, there's the governance side of things, the G, if you will. So your rules and principles kind of defining the rights and responsibilities and expectations of different stakeholders in the governance of your entity or different corporations. And as I mentioned, all of these need to be taken into consideration along with those financial factors now. A lot of stakeholders, both internal and external, they're no longer just strictly focused on the financials and the P&L. They're asking for this information to help them make decisions and to help show that companies can provide long-term value outside of just their financial statements. Go to the next slide, Jim. So we'll talk a little bit about sort of what are these topics. You know, when we talk about ES&G, there's different buckets, there's different metrics within each that are critical and come into play. So we've brought up some examples here that are in line with Morgan Stanley Capital International and their ratings framework that I'll talk about in a little bit, but there's essentially kind of 35 key issues that they point to, 35 different topics across ES&G that might create risks or opportunities for an entity. And again, as I mentioned, environmental, that's kind of what most people think about when they think sustainability. They forget a little about the S and the G part. Some of these items in here like climate change, natural resource scarcity, pollution, waste, things like that are a little bit easier for companies to think about, maybe because they manifest themselves a little bit more in our daily lives too. So they can kind of carry over into the corporate environment as well. And certainly with what's going on right now with the discussions around climate change, it definitely brings the E piece of ESG into focus and leaving investors and stakeholders wanting information around those topics. When we drill into some of these topics, as some of the different frameworks do that we'll talk about, the information you can provide does get a little bit more granular. These are really kind of the key buckets. There's different metrics, different quantitative and qualitative ways you can measure some of these things. But as you're starting out in thinking about the different areas in the environmental space that you might want to measure and think about in your ESG strategy, these are some of the primary key buckets in that area. If we transition into the social side of things on the next slide, then this kind of includes information about the entity's values and their business relationships, right? So labor and supply chain standards, like I mentioned, employee health and safety, your product quality. One that I like to highlight here too under the product liability section is privacy and data security. So obviously we've been hearing a lot lately too about cybersecurity and how that impacts entities and organizations, obviously with things like what happened on the East Coast with the gas pipelines and the cyber attack that happened there. These are becoming more prevalent, and entities can think about that in the ESG realm. I think it's important to realize as you go through these exercises that in a lot of instances, an entity or, from a private equity point of view, your portfolio companies may be doing some of these things already. They may have policies and procedures in place. And so it's not as if you necessarily need to start from scratch. It's just kind of acknowledging that some of these things exist and identifying maybe where more risks and opportunities do exist. And then there's obviously, diversity and inclusion policies and efforts too that fall under the social aspect of things that have certainly gained even more importance with the events that have taken place over the last year and a half too, in conjunction with the pandemic. I do want to highlight too, this isn't just for external stakeholders, right? But internally within your own entity, organization, within your own firm, what are you doing from a labor management perspective, human capital development, your community relations or community outreach? These are all parts of the social aspect to ES&G that organizations and companies are thinking about when they think about gathering this information to either report on it, make disclosures about it, or provide this information to their key stakeholders. And then kind of lastly, the last bucket is the G bucket, the governance piece of things. So this gets a little bit more into, the corporate governance side of things, your corporate behavior. Includes information on like the structure, diversity of a board of directors, for example, or executive compensation, how you're paying employees. Is it competitive pay? Is it fair wages? Things like bribery and corruption as well kind of fall into this bucket. And then some of the things like related to accounting and taxes, right? Fiduciary responsibilities there in your financial statements and with your stakeholders. And what are your governance and your controls around making sure that your financial information, the accounting and tax information is complete and accurate. That all falls into that governance bucket, and making sure that you're capturing that information for your stakeholders, should that be something that they request or your entity chooses to report on as part of ESG initiatives. So again, some of the information, if you were to drill down into these topics and look at them through the lens of different frameworks, might be presented in a different way or discussed in a different manner. But by and large, these buckets within each of the 3 slides that we just talked about are kind of the key topics that make up what entities are reporting on from an ESG perspective and what they're evaluating when it comes to different risks and opportunities. All right, so kind of why are we here, right? Well, how did we get to where we're at with ESG? Why is it such a hot topic right now? And why is there so much momentum behind it? Obviously, I think within the last 18 months, COVID and the pandemic has played a huge part in that. Companies, organizations, entities needing to really reevaluate the risks and opportunities that present themselves to their organization and how they can kind of withstand some of these other risks that are out there. It's not just COVID, but climate change. And I mentioned the social justice initiatives. All these recent events, they've kind of accelerated that focus and forcing investors and stakeholders to think about these items as long-term issues. How are they creating long-term value for their stakeholders and responding to these risks? It's becoming more than just environmental, which is kind of the easiest thing to hang your hat on, is the environmental piece, but it's becoming more than that. Sustainability, it's been around for a while, right? It used to be known or thought of more as socially responsible or sustainable investing. Entities were, they used to promote giving back to society, right? And that they contribute to society because they're successful. And now entities and organizations, they're kind of embracing the idea that, hey, we can be successful because we contribute to society. So the other way around, and that can kind of help create shareholder value for the long term. Investors, they believe that ESG factors, they're predicative of long-term returns, and they're beginning to see these factors as important metrics in their investment decisions. There's shareholder pressure, regulatory developments, which we'll talk about, that are bringing this to the forefront, but also customers and vendors directly in the supply chain. We're hearing from that they're being asked for this information in just their business partnerships, which is driving this as well. And then employee demands as well. The different employees that are coming into the workforce now, the younger generation, are more conscious about some of these ESG topics and initiatives, which is also bringing it to the forefront as well. If we go to the next slide, right, we can just do a quick search on Google, right? If the topic is new, one of the first places most people look is Google, right? Let's look at ESG. Let's see if we can find some articles out there, see if we can find some examples of what our competitors, other organizations and entities are doing out there. And if you just look at this chart, what has happened in the last year or two, just from a Google Trends standpoint, the interest in ESG is up significantly. Just from a search engine standpoint. And then we have Larry Fink at BlackRock, who has come out in his annual letters and released some other statements on the topic. One of them here on the slide, basically asking companies that they invest in to disclose their plan to align with net zero economy and how that kind of aligns with their long-term strategy, and how they're involving the board of directors into that as well. They want to know that this risk assessment is going beyond just management level, that it's being embedded into the overall enterprise risk management of an organization, and that they're addressing it at the board level. In addition to this comment, Larry's also said, they're going to be increasingly disposed to vote against management and boards when they're not making sufficient progress on sustainability related disclosures and the business practices that are underlying those disclosures. So it's out in the public, people are looking at it. And then obviously when, Larry Fink and BlackRock, when they released their annual letters and they're specifically talking about it and giving guidance on it, individuals and organizations listen to that to kind of see where this market is heading. We'll kind of talk about here in a little bit how this isn't necessarily mandatory yet from a regulatory standpoint, but certainly when you look at the rest of the environment and individuals like Larry Fink making statements like this, it gets into people's attention that this needs to be on their radar from a risk management perspective. So some of these topics we've kind of talked about a little bit, but again, the drivers as to why we are where we are with the ESG landscape, kind of four main buckets, right? Investors and shareholders. Investors are urging companies to build these ESG considerations into their long-term strategy. This is both individual and large institutional investors like BlackRock. They're demanding more disclosures and reporting on these metrics to help them make investment decisions. In some of the clients that Jim and I are currently working with, we've already talked to them about how they're getting investor requests. They're getting questions in the due diligence process as to ESG initiatives. It's things that different investors want to know about, both at the individual level and large institutional investor level. We have real world examples of questions that are being included in the due diligence process that firms and organizations need to be ready to respond to. Certainly within the last year, stocks of sustainable companies or ESG funds have outperformed less sustainable counterparts. You can obviously find exceptions to the rule, but during the pandemic, that has certainly been the case that these companies and funds have been shielded a little bit more, I should say, from some of the risks in the environment that's currently going on. From a regulatory perspective, there's just an increasing trend of making sustainability a reporting and disclosure requirement. It's important to note right now, though, that for public companies, those that have to comply with SEC financial reporting regulations, there's nothing mandatory from a ESG reporting perspective. The expectations are still that companies are reporting material risks to their business in their 10Ks, in their MD&As. That is still expected, even if it's an ESG specific risk and maybe not necessarily just directly financial. But in terms of creating a sustainability report or having a prescribed framework, that's currently not required by the SEC, but the wheels are in motion to change some of that. The SEC did announce in 2020 it's going to begin requiring public companies to disclose description of that company's human capital resources and any human capital measures or objectives that the company focuses on when it's managing its business. So that's going to be included in 10Ks. We've seen them start to appear for fiscal years ended in December 2020. The SEC, they have an investing resource page for ESG on their website. They've created a task force. They've indicated it's a top priority for the Investor Advisory Committee this year. And the House passed legislation actually back in June that's going to require public companies to report on ESG metrics. It's essentially going to direct the SEC to define these ESG metrics. There's still some hurdles it has to go through. It has to go through the Senate. There's obviously opposition to this just based on party lines and that sort of thing. It kind of narrowly passed the House actually. But just to kind of know that these things are in the background and in process, that regulatory bodies are starting to look at this and consider whether this needs to be made mandatory for public companies, and then what is the trickle down to that for private entities as well. Usually it's obviously going to start right at the regulatory level with public companies, but then as that continues to branch out, we would expect that if an established framework is put in place for public companies, that eventually some private companies will follow and some similar guidance will come out for smaller private companies as well. And you also have the stakeholders within the company's supply chain and their customers. I mentioned this, that some of the companies that we talk to as well are becoming, customers are becoming more interested in buying from or partnering with companies that are focused on sustainability. There's a potential for decreased costs through better resource usage, potential for increased revenue as well, and being better stewardship of natural resources. Companies have to think about this more strategically now, and their customers are expecting this. You know, I mentioned on the investor side of things when we talk to private equity firms that they're getting questions about ESG in the due diligence process. Well, similarly to companies that, or portfolio companies, if you will, we're hearing from clients and companies that when they're presented with RFPs to do business with an organization or partner with an organization, they're being asked to provide information around their ESG initiatives. So in these RFP processes, companies are taking those into consideration. And it's important for organizations to have a response to that and be able to provide information based on those questions. And then there's obviously a wealth transfer going on to a younger generation. I mentioned that, you know, the younger generations may be more socially conscious, maybe better advocates of ESG causes. It might be more important to them to work for organizations that are more transparent in their ESG reporting and kind of put this at the forefront of their risk management. So if nothing else, attracting and retaining the upcoming talent of the younger generation, they look for things like sustainable reporting and how you are responding to the different ESG topics that we talked about on the previous slide. So if nothing else, that's a driver in and of itself to that organizations need to be aware of, that attracting and retaining talent, ESG can come into play in that perspective too.
And Matt, we have a question that I thought you could answer since it's timely. Is the MSCI ESG ratings key issue framework the recognized standard or only an example of a framework?
That's a great question. Jim, you can actually, it was very timely, you can flip to the next slide. We'll start to talk a little bit about the different raters and standards and frameworks. So the MSCI that I mentioned is essentially reviews public disclosures. It's the Morgan Stanley Capital International, and you can search on their website for a public company and get a rating of their ESG disclosure, ESG initiatives. Now, not every company is going to be out there. I've searched for some out there, and you know it's not out there, but those that are available can get a rating from this. So I would consider the MSCI a little bit more of a rater essentially than it is a standard and framework. We'll go through some of the standards and frameworks on the next slide. But the thing I want to highlight on this slide here with the raters, including MSCI, is that while there's nothing mandatory from a compliance perspective, right? Public companies don't have to create a sustainability report or have any type of prescribed table or section in their 10Ks right now. There are raters that exist out there and will provide ratings over disclosures that companies are making or over their sustainability reports. It's largely voluntary. I'll kind of point to the CDP, which is formerly known as the Carbon Disclosure Project, right? That one specifically can help companies and actually cities and municipalities, disclose their environmental impact. So it's voluntary reporting. You would essentially fill out a questionnaire and they'll kind of, the CDP will kind of guide you through the process, but it would provide you with a rating. And that can be important too, as we think about the RFP process that we mentioned, or the due diligence process. Being able to provide a rating on your initiatives could be something that's beneficial. So again, the key takeaway on this slide, I don't want to go through every single one of them in detail, but the key takeaway is that these agencies exist. There are raters out there. They're beginning to look at public disclosures that are made, and then there's voluntary raters out there too that you can reach out to and provide them information via questionnaires. And they're actively reviewing disclosures now. I think you don't want to be the organization, if you're a public company, you don't want to be the organization out there that doesn't have a rating or is scoring poorly, especially when your competitors or those in your industry are putting out that information and are putting out those disclosures and reports and have mechanisms to respond to ESG requests. I don't think you want to be the one in your industry or with your competitors, again, that's not being rated or is scoring poorly. If we go to the next slide, then we talk a little bit about the specific standards and frameworks that are out there, right? So one of the current problems with ESG reporting that's getting a lot of pushback, if you will, from the companies and clients we're talking to is they don't know where to start, right? There's all these different standards and frameworks. They're getting, questions from RFP, and they just don't know where to start. And some of these NGOs like the SASB here. Some are headed more by the public sector. The Sustainability Development Goals, the SDGs, are adopted by the UN. But I think what's important is that there's really no right answer. None of these are mandated yet, but there's no wrong answer either. I think these bodies, if you will, that are creating the standards and framework are recognizing that there's too much disparate information out there. It's not consistently reported on. And so they're beginning to come together to outline their vision and commitments to establishing kind of one global sustainability standard, or two standards, if you will, right? We can think about it potentially in the future of the differences between U.S. accounting and IFRS in their international space. Maybe we'll get to something where we have two frameworks or something like that. It's a little too early to tell, but the takeaway is that these entities are starting to come together and establish their own framework and kind of blend these all together so that all companies, all organizations, entities have one thing to use, and it can be a little bit more transparent in the reporting, because hopefully everybody's reporting similar information. Again, there's no mandated reporting or frameworks right now. Larry Fink has spoken and mentioned the SASB standards, which are industry specific standards. I think it has 77 different industries that you can look up and see what would be key topics from an ESG perspective. But there's others out here too. GRI, the Global Reporting Initiative, is probably the most widely adopted right now, especially over in the EU a little bit. They all kind of have their own, I'll call it a flavor of disclosures. It's essentially getting at the same information, but the way it's presented or communicated might be a little bit different based on the framework or disclosure that a company or an entity chooses to use. The key is if you're thinking about using one of these frameworks, you can kind of maintain that flexibility, right? And Jim will talk about this a little bit, but really taking a step back and understanding what is material to your entity, to your organization, to your portfolio companies, perhaps to identify what is kind of the best standard or framework that you should adopt or at least use as a guideline to start to gather some of this information, potentially report on it. A couple questions come in here that I can answer here. One came in about anticipating if a growing number of small companies will opt to capitalize without public equity or debt to avoid the cost of ESG disclosures. Yeah, I think that's a possibility, right? Compliance costs seem to just keep going up and up and up. And I think, as I mentioned, one of the drivers of why some of these standard setters and SEC are getting together is they're realizing that it's too cumbersome right now, and they're trying to get to a point where it's a little bit more streamlined to help with that cost of compliance. If you remember years back when Sarbanes-Oxley came out, right, and the compliance costs that it took for public companies to ramp up to that, I don't know that it'd be quite on that level from an ESG perspective for the disclosure requirements, but certainly there's going to be a ramp up period, especially when or if this does become mandated.
Yeah, I also wanted to add, I agree with that. And I think, companies go public for a variety of reasons. So it's not necessarily, a cost of compliance prohibiting that. But, you add it on to the list of consideration when going public. So I think that's a good segue into my section of the presentation, and I'm going to talk about ESG impacts for private equity, and I'm going to kind of start with the second bullet which is the investment decisions. And investors are really starting to demand this. So as Matt was discussing earlier, investors are demanding that companies have a sustainability mindset or values that are in line with theirs. So, private equity is in a unique position here to, really drive positive ESG profiles, because, I think bad press or negative assessment on anything ESG related can really have, a devastating consequence on a company's sales or profits. And, social media now can effectively be used to boycott companies. So I think, obviously private equity is going to need to really determine what their perspective and what, they're going to be sharing from an ESG perspective. Due diligence is obviously, and I'm going to talk a little bit about due diligence later in the presentation, but really anyone who has an investment strategy where they're putting a premium on ESG or even utilize ESG into the value, they're going to have a process around verifying this information and incorporating that into the value assessment. You know, typical questions that are going to have to be asked, for instance, are going to be, what information do you need? What if a target company declines any request? How are you going to react to that? How can you compare the information or metrics with other firms? And how much weight are you going to put into the value? How is it going to be assessed? And then ultimately, are you willing to walk away from investment opportunities because of poor ESG ratings? I think these are really important questions that as ESG evolves, each PE firm will really need to determine where their stance is. One of the things we're getting asked, as Matt alluded to earlier, is with clients that reach out to them, is helping them really develop internal firm values and ESG principles. The walk the talk and lead by example mentality is definitely going to be a requirement. I'm on a team with Baker Tilly International Associates, and especially in Western Europe at this time, France and UK specifically, if you don't have the credibility in this in this field, you're not going to be able to really drive certain ESG principles. So it's important for PE firms to really establish what their perspective is for ESG factors. And then finally, portfolio companies, and each PE firm, you're going to have influence, either direct from a purchasing perspective or when you're a key stakeholder of their organization, you're going to have influence on how to keep them in line. Are you going to have to put mitigation plans in place for them? So these are things that as you go through an ESG journey, I'm sure some of you are probably already thinking of, but it's going to directly impact the operations within private equity. So as I was alluding to earlier, Baker Tilly is a part of an international network of companies that includes public accounting firms from all around the world. This slide is actually taken from a survey that one of our member firms in France performed. The survey focused on what they consider deal makers. So, respondents were essentially from both corporate finance and private equity, and there was a total of 60 respondents who were split evenly among Asia Pacific, North America, and Europe. So I think, this is a pretty powerful slide with statistics. Everything's, above the 50% threshold. So it's clear that, while Europe may be ahead, around the globe, everybody's taking notice. So I think one of the more interesting statistics is the 90% one here that says they put improvement plans and track indicators in place if ESG related issues are raised during their investment process. So, 90% is obviously a statistically significant number. And, ESG factors are going to be required within some of the core private equity principles. For instance, these considerations will be very important when raising capital, acquiring businesses, and, also exiting businesses. And pragmatically, the market is really beginning to decide that ESG factors are important in the value of a business. The other number I wanted to also point out here was the 60% of deals have been walked away from due to negative assessments on ESG issues at a potential target. So, you know, one of the things I try to think about with that one is, you know, what qualifies as a negative assessment? What really is the severity that, you know, in the due diligence process, a deal would fall apart? You know, is it McDonald's in the 80s using styrofoam containers? I mean, I joke a little bit here, but it's, you know, to think about the scenarios that could relate to it, we probably think more to those sorts of things. Like there was a red flag right away from, like, you know, mining blood diamonds or reliance on fossil fuels. But I think it tends to be, in reality, it's a lot more complex than that, and it's normally a sum of multiple issues. And I think a more logical conclusion here might be that a target company lacked an internal control structure that was actually considering related risk, and an investor determined that it wasn't worth their risk profile. So that was kind of my takeaway from, you know, these key findings from this article. So here's a continuation from Baker Tilly, from the France company, with a focus more on due diligence. And I kind of want to start here at the bottom with what has been the biggest challenge you typically face when conducting ESG due diligence. And I guess it's really telling to me because it's very, you know, broad of where companies are. If you really add everything up, it's only 16% of companies are actually comparing ESG metrics at this point. So there's really, you know, in my mind, a really broad gap between getting the information, finding relevant information, and then actually analyzing, assessing that risk. So obviously, the due diligence process is really going to have to evolve over time. And, you know, with that kind of being said, it depends. Also, what we're finding is depending on regulation in the industry, some companies may have more experience or a requirement of some sort of, say, environmental reporting. So they're more experienced and have better documentation to support their reporting than, say, other types of industries. And, you know, this also kind of leads to the fact that due diligence is a very subjective exercise. And granted, that could probably always be said, in that one investor may have a different determination on value given the same set of circumstances. But I would say, you know, the art and science, there's definitely more art at this point, at this stage, in information gathering and really, you know, determining what you're going to use to determine how you rate or assess the value of a target company. And then kind of this last, you know, top right here, I thought was also interesting. So really only 18% of the respondents said that ESG had no impact on the valuation, meaning, you know, the other 82% really either had some positive or negative assessment that affected the value. So I think this is all really interesting results and really shows how much ground there is to cover from a due diligence and a verification process of things. So I think, you know, over the last few slides, we talked about the momentum growing in the world and US round, but I think it's good to kind of take a step back and really think about what the benefit of an ESG strategy is. And I'm going to disclaim, I'm not I'm not telling you you need to create, ESG only portfolios. I'm a career auditor or consultant, and I'm going to stay in my lane here, but I think it's just, kind of good to talk about the theory here and really understand the potential benefits of an ESG strategy. So, increased demand, the market is demanding this. We're seeing, as we kind of discussed earlier, vendors and suppliers are demanding this, as well as investors are demanding this. So you need to start having some sort of ESG reporting attached. Companies don't really want to be in business that would expose them to unknown ESG risks. So it's really kind of starting up at the top level companies, and it's moving down to more mid-level companies who, are coming for guidance and assistance in this matter. So, obviously, it's really conscious to have sustainability initiatives that are in the company. It's also, it's important to, at a minimum, that you're starting a dialogue, because there might be a perception, if you're not starting this dialogue, that you ultimately don't care and you're not taking it seriously. So, getting really out there and starting to, compile this information will be important. It's kind of like a lost marketing type of thing, if I'm being candid. So cost savings, the theory here is that if a company is truly concerned with ESG initiatives and it's integrated into their assessment of risk, then, they're thinking more long-term. They're not thinking business as usual and short-term fixes to, fix business problems. If a company has operationalized their organization, then they're not necessarily thinking of quick fixes or potentially accepting the risk of litigation. Being proactive about legal and regulatory risks should really, limit litigation cost, strengthen compliance, and you would think theoretically that then investors would probably rather invest in companies that aren't in constant regulation and or experience a lot of regulatory fines. Furthermore, this could be very detrimental to a company's reputation. Finally, increased productivities. The younger generations are much more conscious about this, and millennials, I know millennials are the majority of the workforce now, and Gen Zs are coming up behind them. And soon those two will obviously make up a majority of the workforce. And young talent will want to work places where they believe in a company's mission. And generally studies have shown that if an employee is happy, they tend to be more productive. And then ultimately at the bottom here, if you're taking in all these strategies, then you're ultimately optimizing your investment or your asset. So moving on to kind of how PE can start responding to ESG. And I've kind of alluded to it earlier, but my view so far is that most companies are doing something. It's probably not formalized. It might be fragmented and operating in different areas of the company. And therefore, it would be a difficult process to really report on this. So, I kind of give the example in this case that social initiatives are more likely the responsibility of human resources, since it directly affects employees' experience. But what we're starting to advise and work with companies with is, developing their point of view and their ESG strategy. We notice that many companies, and Matt alluded to it a little bit earlier, and it's part of financial reporting anyway, is that they're kind of informally putting it in their annual reports or their letters to their investors to really, draw in the importance that they're, keeping ESG initiatives front of line and, as the landscape evolves. I think really, two key points for private equity is, the impact of investment decisions and due diligence. As I've discussed, due diligence is not straightforward. It's more art than science at this point. And so an evolution will need to occur, but I think it's important to point out that these conversations aren't going to go away. Dedicating resources to it so you don't have to play catch up when reporting is required is something that PE is definitely going to have to really consider how they're going to address it. One of the more important things I think is understanding your stakeholders' needs. It's broad. It's a broad subject, and you can't do it all at once. All of the different components may be at different stages of complete or maturities. So it's gonna take, you're gonna have to prioritize the important elements in order to build out, develop milestones, record, metrics to really identify the risk and, have goals and objectives. I would also advise that, and this may go without saying, but don't be overly optimistic about your current state. The new trend kind of is to announce that you'll be carbon neutral by 2030, but if firms are, saying this without properly vetting it in their company, that's could really come back to bite you. And you should make sure you understand that completely, understand how it's calculated, understand all the inputs, you have the data in order to determine that's really a reasonable time frame. And finally, this is going to be pretty fluid. We've mentioned all the different frameworks out there, but I don't think anybody really knows where they're going to land. So it's important that you're at least doing something and, building up so that when reporting is required, that you'll be ready and able to properly adapt. So this is our last slide, and I think it really demonstrates the future of mature organizations and how they approach ESG. So really effective process around ESG governance comes down to really proactive compliance and operationalizing it. You must first integrate framework into your risk assessment process, and us auditors and accountants alike, we love a good risk assessment. We already have fraud, financial, operations, so it's just another one that gets added to the list. And with any proper oversight, the board should be fully aligned. It should with a policy, and it should really be addressed when you're understanding those stakeholders' needs. So the board really needs to be involved in those decisions. And I think it was it was mentioned in the question, but ESG, I don't know. It's at this point, it's not. I don't think it's a trade-off. It has to really be ingrained in the decision making of the organization, and it's really more of an opportunities. And companies shouldn't be implementing ESG initiatives at a cost to the bottom line. It really should be viewed as a best practice that improves the profitability. And at this point, we wanted to leave about 10 minutes for questions, so that puts me right on time. I think we've answered a few as they came in, but
Jim, there's another one in here I can answer. There's a question about frameworks or metrics specifically for REITs, real estate investment companies. I would, again, just point to that there's, a lot of different frameworks out there. The one that I like to point to in those types of instances, if you're just looking for example metrics for a specific industry, is the SASB, Sustainability Accounting Standards Board. Their website has a great, what they call a materiality map across 77 or 78 different industries. And by industry, it kind of highlights what would be considered key metrics that you would want to consider based on your industry. And that's a good one to drill into for really getting specific metrics that you'd want to incorporate into your ESG program.
There's another question here. Social and sustainability often go hand in hand. Can you explain the difference? So I'll give my first attempt on this. So I would say, you know, social is more, I think sustainability is more about long-term effects. So are you when you're saying if you're environmentally sustainable, it means you're not affecting the environment through your processes. And you know, you're not polluting, you're not wasting, those sorts of things. The social side of things more involved with, you know, the people and social outreach and, you know, having a diverse workforce and those sorts of things. Matt, I don't know what your take is on that.
Oh, I think you summarized it well there. Don't see any others in here at the moment, Jim. We can obviously stick around if there are others here. Seems
So,
another one just came in. Go ahead, Jim.
yeah, no, so correct me if I'm off target, but it seems that most companies are already working on a lot of items that are part of ESG, but might not be doing in a way packaging and communicating new frameworks. I think that's right on. It's right on target. I think a lot of companies, it's not integrated into, say, the enterprise risk management of an organization right now. It's kind of held in different areas, and it's not necessarily excuse me, monitored as a whole into the company. So I think, you know, you're spot on with that.
Yeah, I mean, just to add on, that's a great way to put it. I mean, just some examples, right? We start talking to clients and companies right now, and you know, just as an example, we'll say, okay, well, what do you do around, you know, data privacy and security, if that's a key topic? And they'll say, oh, well, we have, you know, this policy here, and we do we test our vulnerability, you know, annually or whatever it may be. And so to your point, yes, they might have something in place there. You know, if we were to talk about the social side of things, maybe what are you doing from a diversity inclusion perspective or fair wages perspective? And they can point to policies that they have maybe on their HR side of things. So it's fragmented at this point, and what some of the frameworks that we talk about help do is get that into more easily digestible, I'll say, way to report or gather that information. Somebody, did you foresee this being a requirement for all companies at some point, or do you expect it will continue to be at will? You know, I think there's momentum for it to be required. I think it remains to be seen in what form that is, but I definitely think there'll be an expansion just in terms of what companies are expected to disclose. I think there'll still be some aspects that will be voluntary based on, you know, your industry, the size of your organization, and that sort of thing. But all these signs would point to this being a hot topic that in some form or another, there's going to be some expanded regulations on. There are, other questions after the fact. I mean, we have our, contact information up here. Hopefully it was provided in the information on the webinar too, or if you have questions just on how to get started, feel free to reach out to Jim or myself. We'd love to help out and answer additional questions there.
Yeah, and just to reiterate, I do think, accounting firms are starting to be incorporated and asked from a due diligence standpoint to, help out in developing a process around, what you're requesting, what's being reviewed, what metrics are being utilized. So it's certainly something that, accounting firms like Baker Tilly are going to be involved in the future.
Yeah, and the other thing too that we didn't touch on a whole lot here, but is another thing to keep in mind is as this continues to evolve and more disclosures or reporting is potentially made mandatory, it'll be the question of, are those disclosures required to be audited? Are they companies going to need to get assurance over that like they do their financial statements now? Maybe depending on where it's reported, right? If it's something that's added to the 10K or if there's a different process, if it's in a sustainability report. But the topic of accounting firms obviously will become more prevalent as these regulations come out and if there's requirements around auditing and providing any assurance over these.
Another good question. Do you see expanded regulation coming first from Europe or US? And I think what's somewhat interesting about US and Europe, I think Europe is way ahead from an environmental standpoint. I don't know how much they're ahead from a social standpoint, and I would actually argue that America from a governance standpoint might be slightly ahead of Europe, mainly because of Sarbanes-Oxley and the requirements around financial controls, and there's not a lot of